Hi class, today we'll be presenting you the waste management case, manipulating accounting estimates. We'll first start off by providing a brief history of the company, some company facts, financial information, and important disclosures. We'll then dive into some facts of the case, issues and red flags, and also look at the SEC's investigation and findings. We'll conclude with the ending result and some answers to the questions. Let me now pass it over to Victor.
Thank you, Anthony. Hello, everyone. Well, first off, I want to talk about a little brief history about waste management. It first started off in 1894 by a Dutch immigrant called Ham Huizinga. And just an interesting fact, he was throwing away garbage at $1.25 per wagon, which is pretty interesting and cheap back in the day. And even though it started off in 1894, what we know now today, Waste Management Incorporated, started off in 1968. Currently, it's headquartered in Houston, Texas, in the First City Tower, which is the building that you see to your right. Although it was never always in Houston. In 1998, Waste Management merged with USA Waste and decided to relocate their headquarters to Houston, Texas. And since it's such a big company, there are 4 geographic groups. There's the Midwest, the Western, Eastern, and Southern. Now I'm going to continue on with some company facts for the year 1996. The year 1996 is the year when this case first occurred. As I mentioned earlier, Waste Management was based out in Chicago, Illinois prior to the year of 1998. So when this first case occurred, it was prior for them to moving to Houston, Texas. Services included waste collection, recycling, resource recovery, and disposal service. Some of these services were first being done by Waste Management, so they were kind of leading this industry at the current time, being one of the big companies of waste. And customers now included not only residential, but also industrial and municipal. Just to continue with a little more facts about Waste Management, they're one of the leading residential recycling companies in the country. They recycle paper, glass, plastic, and metal. And if you've ever seen in residential areas, they have those big garbage plastic cans where there are different colors. You got the black, green, and blue ones, and each one represents something different. And they're known for the curbside, where you walk out the curb, your garbage, and then the truck just picks it up and dumps it into it, and it just works really great. And that's why it's one of the popular ones. Also, if you guys did not know, the removal of methane gas, they use that and turn it into energy, which is something that's really good for the environment. Currently, Waste Management owns 16 of those waste-to-energy facilities. And also, Waste Management also does hazardous waste and other chemical removal, treatment, storage, and disposable services. Moving along to some key financial information. For Waste Management, the year ended was 1996, as I have mentioned earlier. They filed the 10K on March 28, 1997. And in that 10K, these were some of the numbers that stood out. We had revenues of $9.19 billion, net income of $197 million, and total assets of $18.4 billion. It's traded on the New York Stock Exchange, and for that year, it was traded at $36 per share. Their ticket symbol, if anyone was interested, is WM, and Waste Management first became public in 1971. Not only are they traded on the New York Stock Exchange, but they're also traded in London, Frankfurt, Chicago, and the Swiss stock exchanges. In the 10K report, there was also a very important disclosure that Waste Management showed. For the 1996 statements, they disclosed that the cost of the property, plant, and equipment less the estimated salvage value was being depreciated over the useful life. And the method that they were using were 3 different ones for each different item. For instance, for buildings, they were using 10 to 40 years. Vehicles and equipment was 3 to 20 years, and the leasehold improvements was life of the lease. So that's what they were using in order to depreciate their assets. There are certain case facts that stood out for this Waste Management case. One of them is that they faced pressure from national, regional, and local companies, specifically dealing with 2 things. It was through the pricing and the services. pricing was very tough on some residential, so therefore they went with local companies and even regional ones. Their prices were much lower than what Waste Management was offering at the time. And another was the services. Services included the sanitation, which included porta potties that Waste Management did not have, and also industrial cleaning services. Waste Management did offer it, but it wasn't as well as some of these regional, especially the local companies were offering. And also, Waste Management was also operating in areas where tax revenues benefited the customer than the company.
Now that we have pointed out some facts of the case, it's important that we focus on some issues and red flags which may have encouraged Waste Management to misstate its financial statements. Despite being a leader in the industry, Waste Management financial statements of 1996 showed that the company was facing pressure from a change in the market and environmental industry. Its consolidated statement of net income also showed a decrease in net income. This was definitely a red flag because management may have been encouraged to misstate its financial statements in order to stand out from the competition and also remain a top company in its industry. Before 1997 statements were released, the company issued a press release to amend reports on the Form 10-K and 10-Q for the year ended 1996 and for 3 quarters in 1997. A final red flag on this slide is that the company also named a new acting CEO and CFO to replace the former CEO and CFO, both of whom resigned in 1997. Continuing our discussion with issues and red flags, another important point that we should point out here is that in 1996, the restatements alone took the company from a previously reported net income of $192 million to a restated 1996 net loss of $39 million. The company's reason for the restatements was that it was adopting new policies which included shortening the depreciable lives for certain categories of assets to reflect their current anticipated useful lives and had eliminated salvage value for trucks and waste containers. Second point here on this slide is that the audit company Arthur Andersen had served as an auditor since before the company went public in 1971. A third issue presented here is that every CFO and CEO of Waste Management from 1971 to 1997 had previously worked as an auditor at Arthur Andersen. And as we know, this is too much of a relationship for the client to have with its auditor. After Waste Management decided that it was going to restate its financial statements, the shareholders of Waste Management lost more than $6 billion in the market value of their investments when the stock price went down by more than 33%. And due to this, the SEC, or Securities and Exchange Commission, announced a formal investigation into the company's bookkeeping. Some of the findings included avoided depreciation expenses on their garbage trucks by both assigning unsupported and inflated salvage values and extending their useful lives. They also assigned arbitrary salvage values to other assets that previously had no salvage value. And a final point here is that they failed to record expenses for decreases in the value of landfills as they were filled with waste. If you turn to page 107 in your casebook, you could see some more examples of the SEC findings. In addition to the findings pointed out on the previous slide, it's important that we focus on some more findings the SEC mentioned in its investigation. The improper accounting practices were centralized at corporate headquarters by the chairman, founder, and CEO, Dean L. Buntrack. He was able to conceal their scheme by using accounting manipulations known as netting and geography. Netting is when they report assets and liabilities with one another as a net amount rather than separate assets and liabilities on the balance sheet. And due to netting and geography, they were able to eliminate approximately $490 million by offsetting against unrelated one-time gains. And due to geography, they were able to move dollars between different line items on the income statement to make the financial statements look the way they wanted to present them. The audit committee and internal accountants were also misled, and information was withheld from the external auditors. However, Andersen identified the company's improper accounting practices, and they presented management with these proposed adjusting journal entries to correct understated errors and overstated earnings in financial statements. Management, however, according to the SEC, refused to make the adjustments and instead entered into a secret agreement with Andersen to write off accumulated errors and change underlying accounting practices in the future. This 4-page agreement between Andersen and Waste Management was called the Summary of Action Steps, which identified the company's improper accounting methods and advised 32 steps the company must take in order to change those improper methods.
Hi guys, this is Joanna. I'll be going over the aftermath of the case to review what Victor and Anthony talked about and to tie everything together. Waste Management's fraudulent activity continued after 1997, and in 1999, the company publicly projected results for their second quarter and continued to stand by this projection even after adverse trends in their business made it very clear that that quarter wouldn't be as successful as they first predicted. The SEC responded to this by issuing a cease and desist letter claiming that management was violating U.S. securities laws. This cease and desist order was triggered by the company's announcement of revenue shortfalls on July 6, 1999, despite the fact that their internal budget was $250 million. And this news caused share price to fall from $53.56 to $33.94 on July 7, 1999, and then all the way down to $22.25 a share by August 4, 1999. But despite these negative events and media attention, the company continues to operate today. The SEC settled with Andersen and 4 of its partners in regards to the 1992 through 1996 audited financial statements. Andersen agreed to pay a $7 million penalty, which was actually the largest penalty against any accounting firm at that time. The SEC complained that while Andersen pleaded with Waste Management for years to change their improper accounting practices, they eventually always gave in and certified that the annual financial statements conformed to GAAP even though they didn't. Richard Walker, the SEC Director of Enforcement, said that Andersen and its partners betrayed their allegiance to shareholders and the investing public by failing to stand up to Waste Management's management, and that the firm would have to be held responsible because of the extent of their involvement and serious nature of the fraud. Ultimately, 3 partners paid fines between $30,000 and $50,000 and were banned from auditing public companies for up to 5 years. The 4th partner was banned from auditing for 1 year. These charges against Andersen foreshadowed the allegations made against them in 2001 and 2002 for their involvement in the Enron audit, as well as their eventual demise.